Quick hits. This is the part of the show where we come up with, or we bring to you three ideas that have been in the news recently. And I thought, as always, make a little comment and on each. First one, the bond market is shaking Wall Street again, this time because of worries about tax cuts. As the United States is trying to push through tax cuts, this means the US will take on more debt. The bond market does not like that. And we've seen bond yields rise, and that is not good with or for the stock market. Global central banks talk harsh new economic realities in Tokyo. So global central banks, the head of the global banks met in Tokyo, and they're talking about things such as potential stagflation, higher pricing around the world, slower growth. Not a good thing for central banks because really they don't have the tools in their toolbox to attack that. They can attack inflation, higher prices. They can attack slowing growth separately. But together, very, very difficult. Currency analyst expects Loonie to reach 75 cents this year, and that's Canadian versus US. And that, in my opinion, would happen, or only way it could happen is if we get a tax bill, if we see more debt in the US, and we get no trade deals, no trade deal announcements. So that could happen. And if so, I do agree, you could see a higher Canadian dollar. So let's go to our first one, our first quick hit, the bond markets. See, everybody says that President Trump has all the cards and he talks from a position of strength. I think the bond market has all the strength. The stock market has all the strength. But to me, the bond market is talking loud and clear right now. As the president talks about getting through his bill to continue his tax cuts and take on more tax cuts, increase the deficit, increase the debt, 36, 37 trillion. Right now, they pay over $1 trillion just on interest on this debt. The more the bond market, the bond yields rise, the 10-year, the 30-year, and the more the stock market starts to fall. Our first chart, 10-year treasury, you can see now just under 4.5%. That actually got up to 4.6 recently, and the stock market did not like it. 30-year treasury, that has now tipped the scales just over 5%. Once again, not good. These long-term treasuries, this is what mortgages are priced off of. We've seen mortgages in the US get above 7% again recently. It's come back down a little bit, but overall, not good if you're looking to borrow and grow your business or borrow to buy a home. Our third, I guess, illustration here is the US dollar. We can show the US dollar. US dollar tends to fall when debt levels start to rise. Obvious, it should be, I'm sure, obvious to many of you. When debt goes up, more worries. People move away from the US dollar, and that's why you tend to see gold move higher. And gold is a hedge against the US dollar. You can see how much the US dollar has fallen. And this is against a basket of other currencies, including our own, of course. Our second quick hit that I wanted to touch on is this idea of central bankers going to Tokyo and saying, you know, we could see some problems. Beautiful picture of Tokyo that we got for you. I've never been to Tokyo. I heard it's a beautiful city and something that needs to be seen by everybody. But you can see, as I said, this whole challenge of rising costs and slowing growth. Central banks can fight each of those if they're working on their own separately. When you bring them together and you have a stagflationary scenario of higher costs and slowing growth, then the bank doesn't know what to do. Cut interest rates, raise interest rates. It could go either way, and that is not something that central banks want to have to deal with. So I think from that perspective, keep an eye on what happens, what central banks are saying going forward. And our third quick hit, and this is currency. This is our currency, the Canadian dollar. And analysts are saying our Canadian dollar could move as high as 74, 75 cents. And as I said just a few moments ago, I think to get the loonie that high, you're going to have to see trade deals, well, not hear of trade deals being announced. That's first of all. And if the Trump tax bill gets put through in its present form and we see debt rising, continuing the rise in the US dollar will fall, which will take our Canadian loonie or Canadian dollar higher. And we have a chart on the Canadian dollar. You can see here in and around 73 cents now. So not too far off, 74, 75 cents. But again, it will take a weakening of the US economy to see our dollar move higher. So we're not moving on Canadian strength. Our dollar is moving on US weakness. If you compare our dollar to other currencies around the world, it is still very weak compared to the euro and other currencies around the world. So keep an eye on our dollar. It is important for, especially for those traveling to the US. Right now, our dollar is looking a lot stronger than it was just a few months ago.